The ECB is ready to do whatever it takes to preserve the euro.
The RBI will not hesitate to take whatever steps are required to ensure that financial stability is not adversely impacted in any manner.
And with that, Governor Das pulled off a Draghi today. Even as one housing finance company defaulted overnight and the financial sector eagerly looked for goodies and lines of credit from RBI, the governor merely said that he would do whatever it takes to preserve financial stability.
We will take whatever steps, if and when they are required, we will take the steps. Every year there is an inspection of NBFCs. Major entities are also being very closely monitored in RBI. So RBI will not delay to take any action if and when such action is required.
Coming to the policy, the MPC today expectedly cut the repo rate by 0.25 percentage point on weakening growth and investment in the economy. This marks the third cut in a row, bringing the repo rate down to 5.75%, the lowest since July of 2010. The rate cut decision was unanimous for the 6-member MPC, as was their decision to change the policy stance to accommodative, signaling more cuts in future.
Accommodative stance would basically mean that rate increase is off the table. There is scope to boost aggregate demand and in particular private investment activity while remaining consistent with the mandate of flexible inflation targeting.
The governor also indicated that the RBI intends to keep liquidity at adequate levels in the system and use the available tools as and when required. The governor has importantly also appointed a working group to review the liquidity management framework and communication on liquidity by the RBI.
The Reserve Bank will ensure that there is adequate liquidity in the system to meet the productive requirements of the economy. So RBI will ensure that there is adequate liquidity available in the system.
Highlighting concerns of a slowdown in the economy, the MPC lowered the GDP growth forecast by 20 basis points to 7% for FY20 and to 6.4 to 6.7% for the first half and 7.3 to 7.4% for the second half of this year. Inflation forecast was also revised upwards marginally to 3 to 3.1% for the first half on faster than expected food prices rise, but the inflation forecast was cut for the second half to 3.4 to 3.7%. Dismissing any concerns on the fiscal front at the moment, the RBI governor also said the government is expected to stick to the fiscal glide path.
The government, as I said, has broadly maintained the fiscal deficit glide path, and we do expect the government also to remain fiscally prudent, broadly fiscally prudent.
Other significant non-policy announcements included RBI doing away with the transaction fee charge that it levies on NEFT and RTGS transactions and considering on-tap licenses for small finance banks.
Well, that was the policy. Well, you cannot argue that it was an extremely accommodative policy. My own arguments, not just a rate cut and a shift to accommodative stance, indicating perhaps better liquidity and more rate cuts. That stance coming with a 6-0 vote from the MPC is very telling, should be very comforting for the markets after all the dust settles. Again, both GDP and inflation targets cut, again indicating that the RBI is signaling more dovishness. And finally, that sentence itself in the outlook saying that the MPC thinks it has more elbow room to give a boost to growth. So that was clearly unanimous. And there were other small steps for the banking sector and the financial sector. The effort to put small finance bank licenses on tap, making RTGS free so that more people move to digital. So the policy really has moved in so many directions. And for me, indeed, one of the best takeaways is not keeling over and bending to the wails and travails of the NBFC Mutual Fund Housing Finance Triumvirate, asking them to be man enough to, harvest what they have sown, and saying that the RBI will step in only when markets are in danger. So for me, the takeaways were positive, but what will be the impact for markets, for banks, financial sector and the economy? To answer all these, I have with me an elegant and eminent panel. Rajiv Anand, the Executive Director of Wholesale Banking at Axis Bank, B. Prasanna, the Head of Treasury Global Markets at ICICI Bank, Pranjul Bhandari, the Chief India Economist at HSBC, and Arijit Basu, Managing Director, State Bank of India. Gentlemen and lady, thank you very much indeed for joining us. I have to begin with the lady, also because she's the only economist here. Pranjul, do you think, how many rate cuts do you see, considering that it's a fairly aggressive growth forecast, 7.5% in the last quarter?
Yes, Latha, this policy meeting was as dovish as it can get. There are three policy pillars, rates, stance, liquidity. On all these three, it was highly accommodative. In terms of what we're going to expect in the future, I think some space for a rate cut has opened up. We are ourselves expecting one in October, but not any more than that. So some space has definitely opened up at this point. I think the bigger takeaway is the change in stance, the fact that they've moved to accommodative. And I don't think it's as narrow as what Governor Das meant when he said that we won't hike anymore. I think it has more to it than that. And I think one important ingredient is liquidity. I think the RBI now wants to maintain liquidity at a slight surplus for the next couple of months so that transmission can happen. Seasonally speaking, June to August is good for transmission, and the RBI will support that as well. So this is my big expectation for the future, one rate cut and maintaining liquidity at slight surplus.
Okay, well, since there is a whole world of things to discuss on liquidity, let me do that before I go to the biggest banker. Prasanna, what have you made of this committee, that is working group that is going to be appointed to examine liquidity framework and liquidity communication? What is your takeaway?
So I think, Latha, in 2014 there was this liquidity framework which was established under the previous governor, which basically talked about the fact that you need to keep liquidity at a deficit and and accordingly have the various instruments around deficit liquidity management in the system. Now, I think what RBI is possibly now going to is the fact that by their own admission, possibly the transmission in the lending markets have not happened as much as what they would possibly want. And while transmission in the bond markets have been reasonably good. So I think they would possibly want to look at this entire regime of having a liquidity stance which is possibly aligned with the rate stance. Because I think the earlier framework had played its part when rates were being hiked, and when liquidity was in deficit, you had a much better way of transmitting rates when you are actually hiking rates and you kept liquidity deficit. But when you're actually cutting rates, it's not something that's really working in the transmission, in favor of transmission. So I think they might want to keep liquidity surplus, but at the same time, my guess is they wouldn't want to have a stealth easing kind of a scenario where the weighted average call rate in the market actually starts tracking the reverse repo rate, which then indirectly becomes like a 25 basis point rate cut. So they would possibly want in this discussion or in this framework to include things like various instruments that they would want to introduce to ensure that even though the liquidity turns from deficit to surplus, the rate, the interbank call rate does not really fall below the repo rate, which is what they want to target as the operating rate.
Okay. Well, actually, what the very words they have used is to simplify the current liquidity framework, clearly communicate the objectives, quantitative measures and toolkit of liquidity management by the Reserve Bank. I mean, when you say communication, of course, it's a communication of objectives. But Rajiv Anand, you remember the days in 2005-06 when Dr. Y.V. Reddy first moved from ample liquidity in his stance to adequate liquidity to appropriate liquidity. He was actually signaling tightening by using those three words in three different policies. Do you think that liquidity will be worked into the stance? What is your takeaway from this? Are you expecting a brave new world in terms of liquidity management and communication?
I think I actually like the fact that RBI has moved to understanding and the fact that liquidity needs to be in surplus for transmission to happen. I think is a big move as far as RBI is concerned from the previous stance. Second is, we've seen previous governors use communication very, very effectively to be able to, move markets one way or the other. Whether it was in the foreign exchange market or within the money and bond markets. I remember Dr. Rakesh Mohan, in the market when, yields were at 5%.
Yes.
And such like, Dr. Reddy's comments on the rupee, where I think are, for market players are legendary. And I think, if RBI starts to use communication, much more effectively, the need to actually, go out and hike or, cut rates as the case may be, will actually reduce.
Okay.
And the markets will do a lot of work for the RBI.
Okay. Now to come to the biggest banker, Mr. Basu, it looks like from what both your peers have said that the RBI is clearly communicating that liquidity for the moment is going to be adequate. At least it will be in surplus. Do you think we are now going to see rate cut transmission faster? When are you expecting the first deposit rate cut? In the system, not just for you.
So if you had heard the governor, he very clearly said that in reply to a question that in the last 3 months there has been a transmission of about 21 basis points and which used to earlier take 6 to 9 months. So he indicated that there is already an improvement in the system, and this he of course talked about in the system. Now, as far as system is concerned, at the moment RBI has already talked of seeing whether we can link it to the external benchmark, and SBI, for example, has taken a cue from that, and a large part of our portfolio has already moved into that.
Yeah.
So for us, as soon as there is a rate change, and which has happened today, at least all our overdraft and cash credit above 1 lakh will immediately see a change. But for the system to come about, I think RBI decided to hold back on whether to link it to external benchmark.
Yeah.
But as you know, if you only rely on MCLR, it doesn't work so smoothly. Even if you have a
I'm asking
surplus,
you,
it
Mr.
may not
Basu,
work so smoothly.
I'm asking you for even yourself, outside of that over 1 lakh rupee savings rate, others are not linked. Is SBI likely to move on its fixed tenors anytime soon?
No. So we have linked the entire working capital. If you look at cash credit and overdraft, so all our working capital loans which are above 1 lakh have all been
deposits, sir. I'm referring to
fixed.
I'm referring to
liabilities.
liabilities.
I understand.
And in liabilities, you only have linked over 1 lakh deposits in your savings account. So I'm asking you, what about the other tenors? Do you see a transmission anytime soon?
Why we did that was that analysis that we did was to ensure that what RBI desires to have is to have very quick transmission.
So you're not answering
Now you can have quick transmission. No, I'm coming to that. Okay. I'm coming to that. Yeah. I'm coming to that. We realized that if we just pass on fixed deposit, it doesn't help me in cutting my interest rates on the advances. That was the issue. So even if we were to make a change of 25 basis points, 50 basis points, we had been doing it in the past. And in spite of doing that, we found that the MCLR was not changing to the desired extent that probably RBI was indicating. Which is why we decided that if I have to make a change in my, I can pass on an interest rate change in my advances only if I make it on the liability side. And it was in the savings bank space.
Mr. Basu, I don't have so much time. Mr. Basu, I don't have so much time, sir. Are you going to cut?
Right. We have already done it. We have, as far as overdraft and cash credit, that's part of the policy now. It is instant. So immediately there will be a 25 basis points cut. On the term loans, which is your question, it will depend on how the MCLR moves, that the ALCO will, as for all the other banks, we'll see how much of deposit rate cut we can do.
Okay.
I cannot presume what my ALCO decision will be.
Prasanna.
So that we'll have to wait for a day or two. It's as fair as that.
Okay. I really didn't get an answer from you. Prasanna, what's your sense? Are deposit costs going down in the system?
So I think there will be a marginal reduction in deposit rates followed by a possible marginal reduction in MCLR. But of course, like Mr. Basu was saying, it's all a function of how the ALCO decides and how the function of the various liability profile of the bank is. But I just wanted to add that had the liquidity surplus been in place much earlier, then it's quite possible that the transmission to deposit rate reductions as well as MCLR reductions could have been a little bit faster. Now, by virtue of RBI actually putting it across to a committee which is actually going to come out with a conclusion and a report maybe a month later by the middle of July, to some extent that transmission is actually going to get delayed till the time you actually get the comfort from RBI in the July report when they put it out that they are going to actually keep it in surplus.
Okay, okay. Take your point. What about yields itself? You think at 6.9 we are done? Or do you think there's more scope for market yields to go down? Both for government and for corporates, Prasanna?
So in markets, it's never done, Latha. It's always, there's always something to look forward to. And so basically, I think we feel that the change in stance is a much more important step in this policy, as well as the fact that the verdict was a 6-0 verdict, which actually gives the comfort to the market participants that given the benign global factors, which is lower crude oil prices as well as the lower estimates of growth across the US and the rest of the world, I think there are possibilities of one more rate cut coming in from the Reserve Bank. So we would possibly be penciling in a rate cut either in the August or the October policy. So I think yields have some way to go lower. But that is not to say that there are no concerns at all. Obviously, the level of US yields as well as crude will be watched very closely. In addition to that, you also have the budget which is going to come out.
Yeah.
Having said that, I think I'm reasonably confident that this government would stick by the path of fiscal prudence that they have been doing over the past 5 years, and they will not really let the fiscal line loose. As well as there are a lot of other positive triggers, like the liquidity report itself could be a positive trigger that the market will look forward to.
Fair.
As well as the transfer of surplus from the reserves of the Reserve Bank to the government. That could also lead to some kind of positivity in the government bond market.
Okay, well, I don't share the fiscal rectitude that you and the governor seem to speak about, but maybe my math is different. Rajiv, I wanted to ask you as well, how much can the cost of borrowing for companies fall, be it from the market, be it from banks, say in the next quarter, 2 quarters?
I think if you see where wholesale rates are, CDs, for example, 3-month CDs and 1-year CDs are over the last 1.5 months are down anything between 25 to 50 basis points. So I think it is inevitable that fixed deposit rates will be cut, and I think that will translate into lower MCLRs as we go forward. Whether they will get cut this month in the ALCO or MCLR meetings or next month, I think is only a timing issue.
Yeah.
My own feeling is that we should see maybe 10 to 15 basis points on both sides as we go forward.
Okay, not a great deal that, perhaps not enough to stir up growth or trigger growth. I'll ask the economist that question after this break. Also after the break, that grand statement, we will do whatever it takes for financial stability, but no line of help dropped for the troubled sectors. Is that the way to go? That question to my guests after this very short break.